So I've seen a lot of comments recently asking, why is this channel so bearish? And well, I figure I should probably start to explain a lot of the things that go through my head when I start analyzing the market. So in this video, I'm going to be going through a fair amount of data. I'm going to try to my best to make sure this is as clean and concise as possible. But sometimes I just kind of run away with myself. But yeah, we'll see how we get on. As I get into the video, if you find it useful and informative, smash the like button. I do appreciate that. If you're new to the channel, subscribe, stay up to date with everything that we do here at Cheeky Crypto. If you haven't yet joined us in Discord, check it out, linked in the description down below. Other than that, let's get a start with this one. So here, this is a pretty big chart. This is Bitcoin USD, 1 week chart. Bitstamp is the data source. This one basically has dissected the history of BTC, right? And one of the things that I've been saying for a very long time is that, basically history repeats itself until it doesn't, which essentially means that we've done something different now than what Bitcoin history ever kind of was telling us, which basically means we're writing Bitcoin's history. But let me kind of go into a little bit of detail on why I say that and what that means. Okay, so essentially, we've got a 2013 all-time high, a 2017 all-time high, and a 2021 all-time high, okay? We can see that we had gains of this bull market of 51,849% in 2013. We then see the 2017 was 12,804% in gains. And then we have a 2021, which was 2,068% in gains. Okay, so what do we see here? Well, it's diminishing gains over time, okay, which basically means that if we were to think about supply and demand on an elasticity curve, what we're saying here is that over time, you get less and less returns until you peak and then actually start decreasing, okay, on the kind of curve of demand. So when we take a look at it, we can kind of see, okay, well, yeah, it definitely has been diminishing over time, but what kind of led into that? And then we start to dissect down a few additional things. Okay, we have a bull market, right, where we had the all-time highs. We also have the crashes and the bear market lows, right? So over here, we have an initial 67% crash. It was 133 days to get to that 67%, right? That's the initial move from all-time high. The bear market low was an 86% retracement from the all-time high, and it was a 413-day period. Okay, that took us into the bull market for 2015 into the 2017 all-time high, right? It took quite some time to get there. And essentially what we can see is this progression to the upside, okay, and then an initial, once we had the 2017 all-time high, an initial pullback of 69%, and it was as quick as 56 days, it was over. Okay, we then rallied up, and then we actually had an 84% bear market low from peak to the low, which was 364 days, right? So we can see that the decrease in the bear market length, okay, over that time, but very similar retracements. Okay, then we go into the new bull market of 2019, very rapid growth, and then a COVID crash of 72%, okay, which is pretty, a black swan event in itself, but pretty common of a wave 2 structure, which is kind of where I think we were in anyway. We then moved up and we had the all-time high, and then there was a 56% in 70 days. So it wasn't as big or as steep as the 67% or the 69%, but we saw a 56% crash in 70 days, and then we went up into an all-time high. Okay, then we've come down so far, and we haven't really analyzed this. So let's go ahead and bring in our percentages from the all-time high to our current bear market low of 77%. Okay, so we've dropped down 77%. This is not as bad as the 84% and the 86%. We're not in the same kind of parameters. Okay, so we dropped down 77%. In fact, what I'll do is I will go ahead and add that in. Just into here, okay, 77%. I'll remove the percentage chart. We don't need that bit. So we've come down 77% so far, right? And in terms of the length that has taken us so far, if that was the low down at the bottom here, then we would be going for 378 days in order to get there, right? So 378 days from peak to the low of 77%. That's as it stands at the moment. Okay, and so a lot of people are saying we have to come down towards 84% or 86%, right? Because, that's kind of where history is telling us that we have to kind of go down to. And if that's the case, then we're talking, I think, like approximately $10,000, right? $10,000 is 85.46%, right? So a lot of people are thinking that we have to be sub $10,000 because we, have to go down 84% or so. I don't think there's necessarily a rhythm and a rhyme to that. I think that, yes, it's possible that we do, but it's not a necessity. I don't think that really matters. The main things that we should really consider here is actually why we have slightly different setups than we've had previously. Okay, so coming back to our 2014 kind of bear market, we can see that our pullback actually rested on this 1.236 fib level. Okay, it's a three-wave structure. It comes down, goes up, then comes down. A, B, and C, and it stops at the 1.236, which is pretty typical of a three-wave structure. You don't normally tend to see things go down much lower on a three-wave structure than 1.236. And then, of course, over in the 2018 bear market, you see something very similar. We come down in a three-wave fashion, and we rest just above the 1.236, but a little bit deeper than the 1-to-1 ratio. Okay, so you're in the parameters, okay? You're within the tolerance levels between 1 and 1.236. This is usually pretty typical of a wave C position. Wave Cs usually are 1-to-1 most commonly, but can go up to a 1.236. Then, of course, we come on over to the 2022 bear market, or 2023, however you want to look at it. And, well, what do we see? Well, we do not see a three-wave drop. Our three-wave drop took us into June, okay? And we can draw this in here. We can kind of go, okay, well, here's A, B, and C. But where did that C wave go? That C wave went down to 1.382. which is outside of the scope of a typical C wave, which would be between 1 and 1.236. So we know that it was a bit unusual. And in this particular time period, we were saying not only is an overlapping structure going on inside here, right? It's an overlapping structure is not a good sign. We also kind of hit these levels that made June not the bottom. June could not have been the bottom under these parameters. And instead, it looks more likely to be a W, X, Y, X, and Z, okay, which would actually be this one here, W, X, Y, X, and Z, meaning that the November lows could be the bottom, okay? And it's very possible that it is. And you can kind of see that it narrowly avoids the 1.618, which would trick a lot of people. So it's possible that the bottom is in for Bitcoin. It's definitely possible from that kind of point of view. The issue that we have is then that the structure that has emerged to the upside at the moment also happens to be just a W, X, Y, X, and Z. We're not trending to the upside. And this actually could be a bit of a concern because it does mean that we have the possibility of a big reset. And although we do not see necessarily just yet the fallout of this, it could look something similar to this. A big A wave coming down here, which contains the WXYXZ. A B wave movement to the upside, which contains the WXYXZ. And then a move to the downside that contains a WXYXZ potentially, or even a 5-wave structure. Okay, there's lots of different things that could emerge there. And this is a wild card, it's not a guarantee, but it's a possibility of something that I think is incredibly concerning. Okay, so outside of just the standard kind of data, or what the history of Bitcoin is telling us, is essentially that we have had a short bear market. We're running at the moment 378 days, so slightly longer than the previous one, but not as long as the one before. And we haven't had it as bad. It's only been 77%, right? Whereas 84, 86% was pretty much the common. Now, obviously, diminishing gains over time, the length of bear markets, the length of bull markets, all those kind of things are also in here, but are not really giving us conclusive, steers in the right direction or anything like that. Instead, I think we have to turn to a few other data points. As I said at the beginning, we've now got new variables, new pieces of data here that are basically telling us that the history isn't something that we can rely on from a charting point of view. The charts are telling us that, we potentially have got something new going on that's not been seen in Bitcoin's history. Not only did we cross down lower than the previous all-time high at $20,000, we crossed down lower than that for the first time in Bitcoin history. For the first time in Bitcoin history, we had a retracement greater than 1.236 on the fib scales. And we've seen not so severe retracements initially. We've seen 3-wave structures actually become 5-wave WXYXZ structures for the first time in Bitcoin's bear market history as well. And therefore, we can't just look at it and think that we are going to be following, a very similar setup to what was happening in 2019 straight away. But we can go a little bit deeper. Okay, so this is just chart analysis. What was going on chain is also something that we should consider. Enter some data. So here we have inflows and outflows, top right hand corner. We talk about these all the time. Okay, so up here we can see the from the 1st of January 2023, okay, 1.4087 million Bitcoin goes onto the exchanges. And we can see that 1.4069 million comes off the exchanges, okay? And so essentially relatively flat, that's okay. But I want to focus just on the volume side of things, okay? So if we were to think about bull market, a bull market is defined when the demand outpaces the supply. And a bear market is defined when when the supply outpaces the demand, okay? So essentially it's all about supply and demand. And when we start thinking about Bitcoin going onto the exchanges, we think of that as the supply being made available to sell. And when we see outflows from the exchanges, we look at that as a demand soaking up the Bitcoin off the exchanges, putting it into cold storage, for example. So we see 1.4 million going on, 1.4 million coming off. It's pretty neutral, okay? Now, the volume side of things is where I want to focus, because if we take a look at that, it's 1.4. But what was going on in 2018 in the previous bear market, actually more specifically, what was going on the 1st of January 2019 through to the 20th of February 2019. And well, this is what was going on during that time period. We can see that we had inflows of 2.3236 million Bitcoin going onto the exchanges and 2.3142 million coming off the exchanges. Now, although this is relatively flat and there is a little bit more going on than is coming off during this time period, it's also quite significant that we've had almost 1 million additional Bitcoin being played with during this time. So there's a lot more demand and a lot more volume being pushed through back in 2019 than there is right now. Okay, and this is an important thing to remember. I mean, here we have obviously the line graph that shows that we have pretty much a well-balanced market. We can see that there's a reasonable amount of inflows and a reasonable amount of outflows. Considering we're just coming out of a bear market here, there's going to be people who are transacting quite crazily. And in volume, a lot of volume kind of pushing through. Now, if we come and take a look at our current position, obviously bearing in mind that the dates are aligned, okay, just different years, here we have the equivalent, right, of what is going on right now. We see only 1.4 million coming on, 1.4 million coming off. Again, it's well balanced, it's neutral, it's not bullish, it's not bearish, in the same way that it was in 2019, but it's approximately half the volume going through. So we know that there's significantly reduced volume, yet we've moved pretty significantly in price value. So it's important that we understand that actually what is driving the price right now might not necessarily be the demand that we think that it is. And instead, it's probably better to look at other metrics of other things that are going on in the world that actually help with the value of the dollar, for example, right? So if the dollar value goes down, then you need more dollars to buy your assets, right? It's not that Bitcoin's worth a certain number of dollars consistently, okay? It's all about whether that value of that dollar has increased or decreased and how much people are willing to pay for Bitcoin and whether the supply and the demand is in balance. It's actually a reasonably complex equation. Now, what we have seen outside of the on-chain data and outside of the charts is that we have seen essentially a lot of Forex traders coming out of USD in favor of different currencies, such as the pound sterling, the euro, the Japanese yen, etc. And this is pretty much on the back of what the Fed are doing. So the DXY was pumping like mad, which crashed the market because you need more dollars all of a sudden to essentially pay for your assets. And then, of course, you can see the reverse of this. People who are dumping the dollar in favor of other currencies, the DXY, the dollar index, dropping down, and all of a sudden you need more dollars to buy your assets, right? So what we can see is we need less dollars to buy your assets when the DXY goes up, and you need more dollars when the DXY goes down. And we've seen recently the DXY, at least initially, dropping down. It has started to recover a little bit, and we can now see that there's a significant amount of FOMO and demand coming in to kind of keep Bitcoin relatively stable, even though the DXY is moving up. There's a bit of a balance to be had here between supply and demand, and of course the value of the asset that you're using to buy the cryptocurrency, which in most cases is going to be USD, but sometimes you might have a look at it in Australian dollars, pounds sterling, in euros, and so forth. Each of these different pairs will have a different amount of currency that you need to purchase. So when I come back to our on-chain data here, not only do we see that actually we have significantly lower volume than we were in the previous bull market, it's important that we also reflect on the participants, okay? So in 2018, we have what I've called shrimps here. These are basically 1 Bitcoiners or more. These are retail investors, and basically during the bear market, I talk about this all the time, we can see that there was a low point where people believed that the bottom of the bear market was in. This is the initial crash. 69%, I think it was, something like that. And we can see that they started buying, okay? And it came down into a new lower low. It's okay. Its bottom's now in. We'll continue buying. A new lower low. It's okay. You know, the bottom is now in. We'll continue buying. And so this retail narrative of bad influences in the time, basically saying that the bottom is in, the bottom is in, the bottom is in. And until this flat period over here, retail investors just had enough. They needed to get out. They didn't believe it was going anywhere. It's a scam, all the various different negative news. And essentially what happens here is a pocket of retail investors start selling, and they sell into the actual lows. And you can kind of see it documented here. The orange line is the price of Bitcoin. The black line are the number of wallets that have over 1 Bitcoin in them, and the number of wallets are decreasing as the price goes on down. So you might be thinking, well, why? Why buy here, buy here, buy here, only to sell at a loss? And it's just basically an emotional reaction to various different outside factors. And if we take a look at what the whales were doing, well, the whales were not participating during the bear market at all until they got to this flat period. You've got to bear in mind, there's always a buyer, there's always a seller. Okay, and in the case of whale investors who are looking to buy significant volumes, they like to push the market into liquidity areas. They got to find the sellers, right? So in this flat period here, where retail is starting to sell their assets after paying premium prices, you can see that the whales start to accumulate heavily. Okay, but you might be thinking, well, they were buying before the dump. Yes, that's exactly how these guys work. They can't buy a bottom, and they can't sell a top. Okay, so essentially what they need is they need people to sell, and they need liquidity. Okay, so essentially what you saw here is during this flat period here where retail investors are selling, they are buying it from them. So price just goes sideways. Equal amount of buying and selling, price goes nowhere, it just goes sideways. Okay, and we can kind of see this coming up here, but price does pull back down. You might be thinking, well, if the whales are buying, why is the price going down? Well, there you enter a third player. The third player is the Kraken-sized wallet. This is 10,000 Bitcoin or more, and these are the master manipulators of the market. During the entire bear market, their entire objective was to accumulate in 2018, and they didn't really care about price so much. They just wanted to accumulate as much as possible, and then right towards the very end of the bear market, what do? They flood the entire market with excess Bitcoin. The balance of supply and demand is disrupted. Price drops down significantly. Now, during this particular point in time, what else happened? Well, you saw right when that happened to the downside, once that Bitcoin was flooding the market, this significant surge with these whales. They're like a straight line, like a rocket ship to the upside. Okay, so I think that these wallets are working together, the whales, the Kraken-sized wallet, they work together to basically control the market, move the market in the direction that it's wanting to go. Or that they want it to go. So why do I bring this up? Well, I bring this up because where are we right now? Well, this is where the retail wallets are. They haven't been shaken out of the space just yet. Okay, we can see that they bought this low over here in June. They bought the low down here. Sorry, they bought this low up here. They bought this low over here. They've bought the most recent low, which is the November and FTX crash low. And, yeah, we're still waiting for these guys to sell. Where are the whales? Well, the whales are not participating. The whales continue to come out of their positions. And even right now, they've hit a new bear market low in the number of wallets that have 1,000 Bitcoin. Okay, this is now 2024. At the beginning of this bear market, or when they were actually at their peak, you can see that there was 2,292 wallets. There is 200 less participants right now that have over 1,000 Bitcoin. That's a pretty alarming to most people. If big money is not buying, why should you, right? And then, of course, you might be thinking, well, what's going on with the Kraken? Well, the Kraken's been heavily accumulating during this bear market, just like it did in 2018. So there's these participants, they started to kind of fluctuate a little bit around the November crash, and they've come out of their positions as prices moved up a little bit. Right now, there's only 115 of these wallets, and we'll see if they actually do what I think they're going to, which essentially is flood the system with excess Bitcoin. So all in all, guys, I kind of wanted to go and do a video saying, why am I bearish? Well, I'm bearish because the data doesn't really give us a clean-cut answer to say that we are bullish and that we're in a bull market. Not only do we have less volume going through right now than we did at the start of the previous bull market, we also do not have the same participants playing the game like they were back in 2019 at the start of the previous bull market. Instead, what do we see? We see big institutional players continue to de-risk, come out of their positions, whilst the people left holding the bags are the retailers. We can see we have different variables within the data. You know, not only did we go down lower than the 1.236, we also have a 5-wave structure, a WXYXZ, rather than a typical 3-wave structure. So what does that mean? Does it mean that we can have a bull market in exactly the same way that we did previously? Probably not. It means that we should expect things to be different. I'm not saying that the bottom is in, and I'm not saying that the bottom is not in. I think there's a high probability that it's not in based on the fact that whales haven't been buying yet, Kraken hasn't dumped its bags yet, and essentially retail's still holding its Bitcoin. Until retail sells, whales buy, and Krakens decide to flood the market with excess Bitcoin, I'm not expecting a low to be in anytime soon. Which brings me to that big concern. Maybe it is a multi-year bear market. Maybe it is something that's going to take quite some time to play out. And the bigger economic climate and everything that's going on in the real world should be pretty alarming to most retail investors as well. We all want a bear market. We all hope for a bear market, but we shouldn't really be tricked and duped into thinking that another bottom, another bear market low, the bottom is in, scenario has occurred. You know, this looks to me very similar to what it looked like in June. We are not ready for a bull market. Let me know your thoughts in the comments down below. I'm going to leave this one right there. If you found it useful and informative, smash that like button. I do appreciate that. If you're new to the channel, subscribe and join us down in Discord. Until the next one though, guys, have a fantastic day.